the spreads that we enter, I think live, doing it live, it'll make more sense, right? And vertical calls, most of you guys already know, but some of you guys that don't know, we have 4 type of vertical options. Okay, there's vertical bull calls, there's bear calls, there's bull puts, and then there's bear puts. Okay, these 4: bull calls, bear calls, bull puts, and bear puts. Right, bull calls, when obviously we think the stock is going up, going down, right? Now we're mainly going to talk about calls alone, right? Bear put, bull put, we'll get into it later, I think, instead of confusing you guys, right? But you can also play bull puts and bear puts when you're playing bull calls and bear calls through them. Usually they're priced the same. We'll go over this in the next session, but for now, the 2 that I'm going to go into so you don't get confused is bull calls and bear calls. Okay. Now, these are usually done when, premium, when do you actually do bull calls, right? Let's go over bull calls first, so it's easier. So when do you actually enter them, and what's the case when you, buy bull call spreads? When you think the premium is too high for your account on names such as Melly, Shop, Amazon, anything that's, a big name, trading above $500, so they usually, the premium is really high, right? Even MasterCard, sometimes premium is high, or when stocks IV is really high, right? When the volatility, the implied volatility is really high, the options are priced really expensive. Okay. On high IV, and then when a stock you think will range, right? When a stock will range, like it won't go up, down, but you're just trying to play the range and trying to catch the premium. Okay. And obviously they're safe, highly likely to work out. Okay. Consistent growth in your account if you're very picky with them. With spreads, you will get consistent growth unless you're just on the completely wrong side over and over again. How likely is that? Right? I mean, so yeah. So bull calls. Now let's look at Walmart, right? The spread that we did about we got this last week, right? I basically, what I did, Walmart at that time was trading, I think, around the same range, 141 or so, right? I bought the 142 calls. These at that time were priced at $2.54. Now, right off the back, let's say if Walmart was to go sideways, or so let me just increase the font so people can see after. These were priced at $2.54. I really didn't want to pay that price. So what I did, I sold 140 calls at, I think they were $1.77, I think, or $1.70, because my spread cost me $1.77. So yeah, they were priced at $1.77. Okay. So these I bought, these I sold. If I was to buy these calls alone, the 142 calls, let's say if I bought these alone, right, and Walmart did not move up and Walmart was going sideways, right? The cons here are the time decay would take out the price out of my options. Every day, you're basically paying money to hold those calls. And also, break even on these after earnings would be 142 plus 254, which is 144. 54 price is just the break even on the Friday expiration. Okay. And I just said to myself, that's a big move. I don't think I want to pay that much price for the option. Okay. So instead, I bought the 142 calls and I sold the 144 calls. So how does that work? So let's say if you were to buy one spread, right? First thing I want to see here is my max profit, 144 minus 142, which is $2. It cost me $2 to buy this, right? And then I want to see so the max profit, so $2 is the max profit. And then my cost was 77, which equals $2 minus 0.77 is $1.23, right? So $1.23, which is an increase of almost, it's not 200%, but so a max potential of 159% on these spreads, right? 159% potential, which is not bad. Now to get 159% on these, if I was to buy 142 alone, these would have to go way above $6, I think, right? So if we put the intrinsic value in, that's 142 plus 6, $148 on Walmart, right? And which is a big move for a stock like Walmart to do in a week. Okay, even on earnings, it's a huge move. Walmart does not move more than $2 or $3 on earnings ever. I've never seen it. So here I bought these spreads for 77 cents. And yesterday at the open, so let's look at Walmart right here on the left, the chart. This is Walmart live right now. Okay. And if I refresh this, oh, they're actually at break even right here, 77 cents. You see my mouse right here? They're currently at break even. These went up to $1.30 yesterday in the morning when Walmart made this big move at the open, right? See, at 144.58 was the highest. These actually went up to $1.30 plus. My platform kept shutting off. I actually wanted to scale some out at $1.40. They did not hit $1.40, so I still would have been in anyway, so it's okay, right? But right at the open, these were up. But my calls from 254, I don't think they went up a lot. They didn't. If I was to look at options here, let's see what these went up to. So 142 calls yesterday went up. The highest they went up yesterday was $3.20. The highest they went was $3.20. But my spreads went up a lot, almost a double, right? And it's still holding. For me to make money on Walmart now, as long as it just holds this range, I think by Friday we might get a move towards 140. Today morning I got a nice move. These were up a lot again. But I think as long as the earnings are kicking in, retail strong, maybe by Friday I get a move towards 143.50 or even test the $144 level, right? I can exit these for at least $1.50. Okay, while the 142 calls alone will be in a loss, but my spread will be up over 100%. But let's say if it goes down, nothing works out in my favor. If it stays at 142.50, for example, let's say Friday's closing price 142.50, just an example, I have no idea what it will be. Now, if you were to buy these calls alone and you were holding till expiry, right, these will be worth with the intrinsic value only 50 cents, right? But my spread will be worth also 50 cents, right? These calls will go to zero. 144 goes to zero, but 142 hold value 50 cents. And these are only down from 0.77. My losses are very little compared to 254 to 50 cents, right? Here, I still have some value left in my spread for 50 cents. And another thing I could do here, if I think Walmart continues up, these 144 calls, which I have or which I sold, they are currently going for 34 cents, 33 by 36 cents. I can simply buy these calls back. So these calls, which I sold for $1.77, are currently 0.34. I can buy, if I think Walmart's going to run up from here, I can buy these back at 34 cents. And now I'm only holding, so I lock in all this profit, right? $1.77 minus 34 cents. So I lock in all that profit, the premium which I collect. And now the 142 calls are currently at $1.04, $1.07. And I think if Walmart gets 144 even higher, and these go to $2, I still lock in a lot of profit. So strategies, you can always play around with them. Like the calls that you sell, you can always buy them back at a cheaper price if you think it's going to go up higher. Making sense a little bit? So that's just one example. And here, my spread right now fluctuates a lot. It's at 71 cents. It'll go to 77 cents. It'll go to 90 cents. It's fluctuating a lot, right? But as long as I can just get that move towards 143, 144, I'm not looking for a big move. My spreads will double, right? Bad part on mine that I didn't exit when they were up nice, but that's one. And then we also went in Twitter yesterday. Right, I bought Twitter based on certain things, some news, subscription news that came in, and then I do see a little bounce in tech, maybe end of this week or maybe next week. And let's see what the FOMC minutes say today. They might end up moving the markets to the upside or downside. I have no idea. But Twitter is down from the highs of 80, 75 to 50. 50. This is just a psychological level. Sometimes you don't have to think for the stock. From 80 to 50, that's a 30-point move down. It's likely to bounce from 50 to maybe 60 once and then come back down, right? I mean, it doesn't have to, but like just, stocks don't just go straight down. They'll go down in a controlled way if they're supposed to go down. Now, yesterday it gave us a high of 55. There were a lot of sellers above 54. They sold it right back up. I was waiting, but for me, the level was above 50. It held 50 for a few days. And now we bought next week's spreads. We bought the $54 calls and we sold the 55s. right? I didn't go too far. I went in nearby. Now, if you were to buy the calls alone, $54 calls, we're probably down a lot. But because we just spread, our spread's at 34 cents. So here's what we did on Twitter. What was the ad yesterday for next week? For May 28, 21. We bought the $54 calls and we sold the 55s. The 54 at that time, I have no idea what they were going for. 55s, they're in my other account. So $54 calls we bought. I'm just going to make up a number here. Let's say we bought them at $1.40, for example. And then 53, we sold them at a 90. So our cost was 44 or 40. Well, how much was it? So I bought them at 44 cents. Some of you guys got them at 40 cents. So these were at 96 cents, for example. So basically, instead of paying $1.40, because I thought, even until the next 2 weeks, maybe Twitter just closes at 55 next week, or maybe it goes lower to 50, comes back to test, maybe it comes back to 54 sometime during the week, it comes to 54.50 or 55. Why am I going to pay $1.40 for $54 calls, right? Here, my break, if I'm buying these calls right here at $1.40, right? If I'm buying these calls at $1.40, right off the back, if Twitter just goes sideways by Friday's expiry, I at least need Twitter to close at 55.40 or more. 55.40 is my break even on my calls. Okay, which if I was to buy $54 calls alone. Okay, but here 55 is tough resistance, right? So by next week, it can easily go to 54.50, even 55. Even if we get the move this week, we can easily exit our vertical calls for great profits. And I sold the $55 call. So let's see what they're going for right now. Right now, they're going at 34 cents. I'm only down 10 cents on my spread, and I'm not worried. Even if Twitter holds sideways here for however long it does, I'm not worried because my spreads will continue to hold value. A lot more than the calls. They won't lose as much as the calls, they'll still hold. Only if we see a significant downside. And here somebody asks, can they average down? I don't average down on my calls like this. I don't do it so fast because instead of averaging down, I would rather buy a week more and go closer to the strike. In case if it fails, at least my calls hold value, right? The averaging down is very tricky concept. Most people, when they average down, they lose that money as well, right? So I'd rather let this play out. If it goes up, I'm already in the position. I'll make money regardless. Just ask yourself how many times you guys average down where you guys lose money. So vertical calls, you buy a strike and you sell a further strike. You sell a further strike. Okay. Is this making sense if you're new? Yes, you can sell them separately once you're in, but then I always suggest that you execute it at the same time, right? I mean, if you're going to do that, then the calls that you buy, you should sell them first. I mean, sorry, you should buy those back first just for risk management, because you never know what's going to happen in the market. A little lesson for you guys today. A lot of you guys have started trading crypto recently. So just ask yourself what happened in the last 24 hours. If you were long on most stocks with leverage and you were trading, you're now down on your positions, and some of you guys have given up all your gains in one shot, right? Cardano, I mean, from 240 went to $1, more than a 60% drop. Bitcoin, trading at 65 a few weeks back and now hit 30, lost 50%. So these moves happen, and sometimes they happen in one day. So don't get caught in those. You have to be very careful. And then another spread that we entered was triple Q. Here, this is a butterfly spread. I mean, it's still up 50% from our entry. Our entry was 19 cents. It's still trading at 28 cents. We did lock in over 100%, all that bought in the morning. This was type of a hedge play on triple Qs, right? I'm still holding mine in case there's downside after FOMC minutes. These are going to shoot up. These basically, we bought a range to trade. So on triple Q butterflies, somebody asked to go over these. I'm just going over. Yesterday's closing price was 322, I think. So yesterday's closing was 322-ish. And then somebody in the group, Gokul, he came up with a play that in case if we do have downside in the morning today, which was likely, that's exactly what happened, right? So we bought the range between 316 and 320 to play on triple Q, right? You could have bought put spreads here as well, but we just bought the 316, 320 range. So what we did, we bought the 316 calls deep in the money, right? And then we sold the 318 calls which were also deep in the money, right? We sold these, we bought these, and then we bought the 320 calls, and we bought these. So we bought the range. And so here we bought one. So for example, I'll go for one butterfly spread. Here we bought one contract. Here we sold two contracts. And here we bought one contract. Now, how does this exactly work? Why do we only buy one 316? Why do we sell 318? And why do we only buy one 320? The reason being is because here you have one contract at 316, but let's say 318, QQQ shoots up. Let's say it goes to 330, for example. Your one contract will only protect one 318 call. Then how about the second $318 call that you sold? You need protection against that as well. So we buy the 320 call. So we buy the difference between the first and the mid strike has to be the same on the other strike as well. So there's a 2-point strike difference here in the butterfly calls. And a lot of YouTube tutorials that go in details to explain. So here, what exactly happened was the Qs opened up low. So right now on the left, this is live right now. You can just see it here. So the 320 calls are now going for $1.32, $1.36. And yesterday they were going up for a lot more. The 318 calls are currently going for 278, 284. And then we have the 316, 454, 469. And how does the math work here? It's pretty simple, right? 316 calls are 462. And then we have the minus the 318 calls, which we have to buy back if I was to close this right now, 2 times 283, right? And then plus the call that I bought here, which is $1.34, for example, right? And this should give us 30 cents. And the maximum profit here is 318 minus 316. You can choose other price at $2. Now let's say QQ's today, at the FOMC minutes, if we get a dip, there's some negative news, it comes below 320 or 319. These are going to be up around 70, 80 cents. These butterflies right here, which are going for 26 cents currently. And we got this in only for 19 cents, right? So our buying price on these was 0.19, and our maximum profit is $2, right? Which is almost what, more than 700%, I think. So these are more than, 952, sorry. So these give us 950% plus potential. That's only a triple Q's pin 318. But the whole point of this buying this range was to the downside, and QQQs are closed somewhere around 319 today, right? If there's no downside, no problem, then our other positions go up. So this was more of a hedge. So I'm still not worried about this going to zero. We already locked in a half for 100%. Some of you guys I know are probably so confused, like, what is this? But the longer you stay in the markets and you look into these strategies, the more money you'll make. So, guys are pretty straightforward. Vertical call spreads. I'll go over them again. Like let's go over BABA. I'm still holding my BABA spreads. Right, I'll just quickly go over BABA here. I'm holding 210 and 215s, right? So and they're still going for $2.07. Wow. So I bought these calls. So I bought the 210s just to show you guys the pros of this. And then I sold the 215s, right? When I entered the spread, the 210s were a lot more expensive than this price right here, I think. And same with the 215s. And they hit a high of $3.50 yesterday. I didn't sell. I'm still holding them because I do see BABA closing about 215 this week, right? And so 210 right now, they're going for 212. My entry on these was 250, I think, from what I remember. My entry was 250. Apparently, they're going for $2.12, and they hit a high of 350 yesterday when BABA was up here. But I still didn't sell because I thought, I can get more than $4 on these. Maximum profit 215 minus 210 is 5, and minus 250 my entry. So it was a double potential basically. And here, the 210 calls, when I bought them, they were probably going for $455. I think. I have no idea. I think they were going for a high price. But my break even here is $212.50 on BABA is my break even price by Friday. And here, as you can see, it's in such a tight range. It's just going sideways right here between 210 and 215 for the last 3 days, right? And if I get a move above 214 now, 215 with the time decay, these are going to jump up a lot. So even if BABA goes up to 212, 212.50 or 213, just stays sideways, I will exit these in profit. So that's the whole point of doing vertical call spreads, right? I mean, your risk is defined, and then your profits are also defined. The maximum profits you can have. Buying calls alone, if the stock skyrocket shoots up, your percentage will be a lot higher, yes. But on spreads, your profit is also defined, right? You can have profits of thousands of percents also if you go further out of the money, but then the stock needs a bigger move, right? Somebody entered a beautiful play today, Shop Butterflies, Al Professor. He's been doing really great with these strategies. And he just recently learned them. So he bought the 1137.50s. Okay, his third strike was 65 on the butterflies. I'll just quickly go over this, and then he bought the 1130s, I think. So he gave himself range of 35 points. So he's playing also on Shop Butterflies. He's playing a range of 35 points. Okay, so if we go on Shop's daily chart right here for next week, he's playing this range right here that there's not going to be a big move. Right, Shop, I think goes Shop's at 1160.
Yeah, it's written.
All right, guys, just give me 1 second. I'm in a position. Hold on, guys. All right, if you got into Shop with me, our calls are at 31 bucks from 25. Nice. So September $1,500 calls. I'm not selling these, by the way, right? Because I do see a bounce for 1,300 on Shop. This is going to be a grand slam. So above 30. Nice.
Agree.
I'll be at the back. Wow. So he is seeing a range on these birds. And as you can see, the spreads are completely messed up here, negative 629.90. You just have to calculate these in your head, sometimes with a mid-mark, and see what the best possible fill that you can get. So he sees Shop trading between 1130, 1165. All this excitement right now is great, but let's say next week Shop comes down towards 1160, or even if it stays somewhere around here by next Wednesday or Thursday or Tuesday, his fly. So he basically bought 1130 calls. He sold 1147.50s, right? He sold two of these. So you sell two, and then he bought 1160 call, right? Sorry, 1165. So the difference of 1750 on both sides, okay? And next week's Shop, if it's trading anywhere between 1130, 1160, given any point of the week, which is very possible, right? His butterflies will be up a lot. He can easily get $4.55, $7 on these. On the next Thursday or Friday, if Shop is trading between 1130 and 1165, and he only got into it for $1.85. But if you were to buy the 1130 call alone or 1147, look at the prices here. 1130s are going for 50, 1147s are going for 42, 1165 is going for 33, 34. Why pay so much for these calls? And then, why not just play a range? And yes, if you think Shop makes even a bigger move, you could easily change these strikes. You can maybe buy 1170s if you think Shop goes towards 1200, right? And then 1230. You can play a further out range, which will cost you even less to play. And if you think Shop, closes here, you can. That's when you bank 500,000% on butterflies, right? I think I'm going to enter one on Shop soon. I will. I think it's almost there. Yes, to also right now it's a resistance, but to understand how to execute them, I can only teach so much like this live, right? I can speak here all day, but do learn them. Please watch tutorial on YouTube, and somebody's asking you. For choppy market, Sahaj, the best thing in a chop market, if you realize, I've been buying in the money or closer to money calls and selling just a little above it, right? Like for example, Baba, I did 210, 215. Twitter, I did 54, 55 for next week. Walmart, I did 142, 144. And triple Qs, we did butterflies just near in the money. So to play this choppy market, if you can learn spreads and playing closer to the money, even if the stock doesn't go up, it goes sideways, there's value left. There's value left in your spreads, right? Your positions will not go to zero. Okay, there's value left in the spreads, and you will have consistent gains in your portfolio. Like Bob, I'm not worried about it. Look at it's just making some dumb moves, but my spreads are still at 215. I'm not worried at all. And I just bought them at 250. But my calls would have been down a lot. Okay, and plus I would need a bigger move on calls just to break even. So roll over if you think there's Yeah, you can always, Cody, you can always roll over. If you think there's more potential, right? You can always lock in the profits near data and just roll over to like the following week. And let's, for example, Baba, if you think Baba by the end of April, sorry, May, June, by the end of June is trading above 215, for example, let's go further out, 18th, let's go 25th June on Baba, for example. You can do spreads on further data calls as well. So 210 and 215 here. If you were to buy the 210 calls for June 25th, they're going for $9, right? But if you were to do a spread, like you were to finance your calls, you can buy the 210s and sell the 215s, where you can get them for 240ish. I think you should get the fill for 240, 230 here, and just chill on and just hold through. If Baba goes above 215 and the longer it holds above 215, these will continue going up every day. I mean, it's an easy way to double your money. And if you have a big account and you want to throw in a big amount, I suggest playing spread. Then you go further did it, because with those you can really make a lot of money. You don't always have to go for 100, 200, 500%. But in options, if you're aiming for 25 to 30% and you're playing them safe and your losses are very limited, you can make a lot of money. You can make a killing off of it. And let's say Baba comes, you get into the spread for June 25th. On the left, you can see, right? And Baba dips to 205, and you think this might be a bottom. You can buy back the 215s, lock in the profit on those, and continue holding the 210s for a potential move back to 215 maybe, and then sell those. So you can make profit both ways. But for that, you have to be very careful in how you do them, right? It requires a lot of calculations, and then you have to do a lot of research on the market also to confirm your um, if you're right or wrong. The really to first see sometime when the IV is really high, and for example, let's just go where GME has really high IV. That's the one I can think of right now. So GME's IV actually has dropped a lot from recent months because of the sideways consolidation, but it's still up a lot. It's still up above 100. Now, if I was thinking that, you know what, GME holds about 170 for this week, but the calls are still going for $6. So it needs a $6 move to the upside just to break even by Friday. But what I could do is I can buy the 170s and I can choose to sell the 180s this week. So 170s are going for $6. 180s we can sell for a 335. It's costing me $2.85 here showing, but I can probably get a fill for $2.80. And our max profit here is 10. So which is not bad. It gives us more than a 230% potential profits on this. So if GME, let's say, closes near 180 or 178, 180, you can sell these for more than a double. While your calls, you're only going to break even almost. Make sense? You see why spreads are so helpful sometimes? So guys, I hope this session helped. This was just the vertical calls only. I do want to start showing you guys vertical puts as well. Or another thing that I can show you guys, like on GME, let's say, for example, if you think GME goes a lot higher, I mean, this is the base. You can always, or if you think it's going to come down and it's not going to make a big move, you can simply roll this out further 200 calls. And let's say 300. Now, don't do this. The odds are against you, but you can sell this spread as well. You can sell spreads here, the call spreads. What do I mean by this? I can sell the $200 calls and protect myself by buying the 210s. But this I would not do because the odds are against you. You only get 35 cents, but the loss is up to 10. But you can sell calls by doing spreads. If you think the stock is going to stay sideways or go down, or there's tough resistance, you can make a lot of money on it. I mean, one play which I did, it was such an amazing play. I think I was just a week late on it, right? HD, I did lock in some profits, but then eventually had to buy it back. It was a big red trade for me. But at 345, from 246, Home Depot ran almost 100 points in like less than 2 months, right? Here, you could have easily sold the 350s and buy the 350, 250s. You could have made a lot of money, right? And it gave all the gains back. So sometimes when the stock is too extended and you think is due for a pullback or a consolidation sideways move, you can sell call spreads instead of buying them. And guys, shop is flying. Shop is flying. I bought the September 1500 yesterday, and they're at 32 bucks from 25. I'm not gonna do nothing, just gonna chill on it. Let's see the shop's weekly chart. Yeah, if we have a bounce in tech, I think shop goes towards 1200 here. Yep, and the weekly looks good too. Anyways, guys, the market are still choppy. There is no direction. I have no idea what the markets are going to do in the coming days, coming weeks. I'm just playing day by day. So do spreads in this market. You'll be thankful to yourself. And if you don't believe me, ask Gokul, Gautam, and El Professor. They've been killing it.